Agriculture income. We all know that agriculture income is exempt under Section 10(1) of the Income Tax Act 1961. But what constitutes agriculture income and how to compute the tax liability in the case of a person who has agriculture and non-agriculture income is very important. So let us begin with the video. Topics to be covered: definition of agriculture income, section 21A, taxation, partial integration of agriculture income with non-agriculture income, and Rule 7, 7A, 7B, and Rule 8 of Income Tax Rules 1962. Definition of agriculture income, section 21A. Agricultural income means any rent or revenue derived from land which is situated in India and is used for agricultural purposes. For example, there is a landlord. He has got three agricultural lands with him, land A, B and C. Land A he uses for cultivation. He earns an income of rupees 2 lakhs. Land B he gave it on rent to another farmer who uses it for cultivation and he earns a rent of rupees 3 lakhs. Land C he gave it on rent for movie shoot and he earns an income income of rupees 10 lakhs. In the first case he uses the land for agricultural purpose, so the income earned of rupees 2 lakh is exempt. In the second case, he gave it on rent to another farmer who uses it for agricultural purpose. So rent earned by a landlord of rupees 3 lakh is exempt. In the third case, he has given the land on rent for a movie shoot. Now movie shoot is not an agricultural activity. So the rent income earned of rupees 10 lakhs is taxable. Rent received in kind will also be exempt. In the above example, if the landlord received a rent from the farmer in kind, that is, he receives 500 kgs of rice, which is equivalent to the rent of rupees 3 lakh, then in that case also it will be exempt. Any income derived from such land by agriculture or the performance of a cultivator or receiver of rent in kind of any process ordinarily employed by a cultivator or receiver of rent in kind to render the produce raised or received by him fit to be taken to the market, or the sale by a cultivator or receiver of rent in kind of the produce raised and received by him in respect of which no process has been performed other than the process of the nature described in paragraph 2 of this subclause. Now what does it mean? For example, conversion from paddy to rice. There are many processes involved, that is cleaning, husk, separation, polishing, etc. Unless these are done, the product cannot be sold in the market. So these activities are also agricultural activities, and any income derived from these activities, that is conversion from paddy to rice, will be exempt. Conversion from sugarcane to sugar will not be considered as agricultural activity, as sugarcane is a marketable product. No further processing has to be done to sell sugarcane. So conversion from sugarcane to sugar is not an agricultural activity. Any income derived from any building owned and occupied by the receiver of the rent or revenue of any such land, or occupied by the cultivator or the receiver of the rent of any land with respect to which, or the produce of which, any process mentioned in paragraph 2 and 3 of subclause B is carried on. That means, now suppose there is a dwelling house which is situated near or on the agricultural land, or there is a storehouse which is situated near or on the agricultural land. Now this dwelling house is a place which is used for temporary stay of workers or farmers or cultivators on the land, and storehouse is used for storing the agricultural produce. So if they are situated on the agricultural land or they are situated near agricultural land which is used for agricultural purposes, then any income from the dwelling house and storehouse will be treated as agricultural income. However, if such dwelling house or storehouse or other outbuildings are used in letting for residential purposes or for the purposes of any business or profession other than agriculture, then it will not be considered as agricultural income. One more small point I would like to state is any income derived from saplings or seedlings grown in a nursery shall be deemed to be agricultural income. Taxation, partial integration of agricultural income with non-agricultural income. This method is applicable only to individuals, Hindu undivided families, association of persons, body of individuals, and artificial judicial person. That means for companies, limited liability partnership firms, cooperative societies, and local authorities are excluded from using this method. Their entire agricultural income is exempt from tax. Now, why this is so? It is because in case of individuals, Hindu undivided families, association of persons, body of individuals, the tax liability is calculated on the basis of income slabs, whereas in the case of companies, firms, cooperative societies, etc., there is a flat rate of taxation. So conditions to be satisfied is the net agricultural income is greater than rupees 5,000 during the year, and the non-agricultural income, that is the total income excluding net agricultural income, is above the basic exemption limit. Calculation of tax as per partial integration method. This method I have given an example in the next slide. You can just pause the video and look up at the various steps which are given here. For example, Mr. A is a resident. His age is 30 years and he follows old tax regime. This is his income for the financial year 22-23. You have to compute the tax liability for 22-23. Income from salary is 5 lakh. Income from house property is 3,50,000. Agricultural income net is 1,50,000, which is exempt under section 10(1). So his gross total income is 8,50,000. All the conditions of partial integration are getting satisfied. That is, Mr. A is an individual. His agricultural income exceeds rupees 5,000 and his non-agricultural income exceeds the basic exemption limit, that is 2,50,000 in this case. Now first you have to take the aggregate of agriculture and non-agricultural income. So in this case it is 10 lakhs. You have to calculate the tax on 10 lakhs based on the current slabs. The slabs I have mentioned also. The tax liability comes at as 1,12,500. Then you have to take the total of agricultural income and the maximum exemption limit. In this case, maximum exemption limit is 2,50,000. You add the agricultural income on to it and calculate the tax on 4 lakh, which comes to 7,500. From 1,12,500, which you have calculated earlier, you have to reduce 7,500, which will give you 1,05,000, on which you calculate the surcharge, and the total tax liability comes to 1,09,200. In case this method was not required to be applied, then tax would have been calculated on 8,50,000 as per the tax slabs mentioned, and you add a surcharge, then the tax liability comes to 85,800, which is less compared to the tax liability computed by partial integration by 23,400. But partial integration method has to be followed. So you have to follow the partial integration method and your tax liability will come at 1,09,200. Rule 7, income which is partially agriculture and partially from business. In the case of an income which is partially agricultural income as defined in section 2 and partially income chargeable to income tax under the head profit and gains of business, in determining that part which is chargeable to income tax, the market value of any agricultural produce which has been raised by the assessee or received by him as rent in kind and which is utilized as raw material in such business, or the sale receipt of which are included in the accounts of the business shall be deducted, and no further deduction shall be made in respect of any expenditure incurred by the SSE as a cultivator or receiver of rent in kind. Let us understand this with the example. There is a company called ABC Limited. It has agricultural land on which it produces corn. Now, corn is readily sellable in the market, that is, there is a market available for corn. From the corn, the company produces cornflakes in its factory. The first activity, that is production of corn, is an agricultural activity, whereas the second activity is not an agricultural activity. Now, suppose ABC Limited produces 1000 quintals of corn and uses 750 quintals for producing cornflakes, then 250 quintals sold in the market will be treated as agricultural income and will be exempt from tax, and 750 quintals will be treated as raw material and its cost will be allowed as deduction in computing the business income from the sale of cornflakes. Now suppose the entire 1000 quintals are used in preparing cornflakes, then the market value at which the corn is ordinarily sold in the market in its raw state or after application or to it of any process ordinarily employed by the cultivator to render it fit to be taken to the market will be considered as agriculture income. Rule 7A, income from the manufacture of rubber. Income derived from the sale of rubber obtained from rubber plants grown by a seller in India shall be computed as if it were income derived from business, and 35% of such income shall be deemed to be income liable to tax. That means 65% is agricultural income and 35% is business income. Rule 7B, income from manufacture of coffee. Income derived by the seller in India from sale of coffee grown and cured. I've explained it in the diagram what is meant by grown and cured. If such a case is there, then agricultural income will be 75% and business income will be 25%. If the coffee is grown, cured, roasted and ground with or without flavors, then 60% will be agricultural income and 40% will be business income. Now I explained all the activities in the diagrams for easy interpretation of the rule. Rule 8, income from the manufacture of tea. Income derived from the sale of tea grown and manufactured by the seller in India shall be computed as if it were income derived from business, and 40% of such income shall be deemed to be income chargeable to tax. That is, agricultural income is 60% and business income is 40%. Now let us understand all the rules which are discussed with the help of an example. ABC Limited is an Indian company having diversified operations. You have to calculate its business income. Following are the details in serial number 1, business of growing tea in Darjeeling. This comes under rule 8. So 40% of net income of 30 lakhs, that is 12 lakhs, is business income. Serial number 2, business of growing coffee in Kerala. This comes under rule 7B. So in case of land which is for growing and curing, 25% will be treated as business income. So 10 lakhs of 25% of 40 lakhs, that is 10 lakhs, is business income. And in land B, it is used for growing, curing, roasting and grinding. So the net income of 35 lakhs, 40% will be business income, that is 14 lakhs. Business of growing rubber in Assam, this is covered under rule 7A. So the net income is 30 lakhs, out of which 35%, that is 10 lakh 50,000, will be business income. Manufacture of tomato ketchup in a plant in Mumbai, that is the revenue is 120 lakhs, processing cost is 30 lakhs. Now the company produces tomatoes on its own land situated in Maharashtra. The market price of tomatoes for producing the ketchup is rupees 40 lakhs. Here, rupees 40 lakhs will be treated as agricultural income and will be allowed as a deduction. So, the revenue will be 120 lakhs minus 30 lakhs minus 40 lakhs. So, your total net income is 50 lakhs and that will be your business income. Now, business of growing tea in Sri Lanka. Now, this is business from a land outside India. So, rule number 8 is not applicable in this case and the entire income of rupees 25 lakhs is taxable. So, the total taxable business income comes to 121.50 lakhs. Now, you can pause the video and again see the example and understand it. Thank you. If you like the video, please click on the like button and subscribe to my YouTube channel.